Nigeria's fiscal authorities are proposing a leaner budget for the 2014 fiscal year, a budget of 4.495 trillion naira that will be predicated on a lower oil revenue benchmark of $74 per barrel has been sent to the National Assembly for consideration. Now, to discuss the implications for Nigeria's economic growth targets, I'm now being joined by Gregory Cranston, economist at FBN Capital. Thank you so much, Gregory, for joining us.
Yes, pleasure.
Now, looking at the numbers, it's quite interesting to see that the federal government is looking to adopt a leaner budget for the 2014 fiscal year. We're seeing it 492 billion lower from what we had this year. That was 4.98 trillion. But what's also interesting is a lower oil benchmark. This time it's being pegged at $74 per barrel from $79 per barrel for the 2013 fiscal year. Now, we know that this was a key sore point for the National Assembly members and, of course, the presidency. And we saw a long stretch of debate and bickering and, of course, hostilities. Do you think we could be looking at a repetition of that?
Well, I think it's a fair point because as you say, the last 2 years, fiscal years, the budget, there's been last-minute bartering between Assembly and Executive over the threshold, oil price threshold, because as we know, the lower the threshold, the more money supposedly goes into the ECA or the SWF, and there's less for spending by the MDAs. So clearly the federal government favors more savings, and the Assembly favors more spending. So I think the answer has to be yes.
Okay, now moving on, the fiscal authorities are also proposing a reduction in capital expenditure and a rise in recurrent expenditure. The recurrent expenditure is now being pegged at 74%, while capital expenditure is now being pegged at 26%. We know that the fiscal authorities have been saying over the last 2 years that they're looking to reduce what they spend on personnel costs and put more money into capital votes. Now we're seeing a reverse of that trend, and of course that was also another sore point for both parties. So where do you think, what could be a middle ground for both parties?
Well, yeah, very interesting. I mean, as you say, first I'd say the 2013 projections were never going to be attained, i.e. 68% recurrent, 32 capital. I mean, if you look at, for example, the outturn in May this year, the actual figure was 76 recurrent and 24 capital. So the 2674 capital then recurrent may be realistic, I think. And we also have to bear in mind, of course, that 2014 is the last full year before Nigeria goes to the polls. So consequently, while the economy is crying out for more capital investment, the year before elections is not the most likely time to have that.
Now, the fiscal authorities are saying that they're expecting lower revenues. We've seen that happen so far this year. We've had the oil theft and pipeline vandalism, even though we've seen higher oil prices at the international oil market. Now, the fiscal authorities say that the reduction in capital spending for 2014 is a fallout of the government's projected reduction in revenue for 2014. Do you think this is enough justification?
Well, yes, because where we are now, I mean, we can comment on what the assumption is for the current year, which is 2.53 million barrels per day, and we know next year 2.38 made provisionally. But where's production running currently? Well, some people would have you believe that it's running not much more than 2 million barrels a day, which is why, as you say, year to date there's been a shortfall on oil revenues, gross oil revenues, and ultimately retained expenditure for the FGN and the other tiers of the government. So, yes, I mean, I think it's, I even question 2.38. Let's see. I mean, it depends what view we take on whether these losses, what extent of these losses are reversible or recoverable, let's say.
Now, what likely impact could we see on the broader economy? We know that the federal government is embarking on an ambitious infrastructure project, even though it's going to be in partnership with the private sector. But there are also other sectors of the economy that the federal government is trying to boost, particularly agriculture. So if we're looking at lower spending, if we're looking at the government perhaps not being able to curb oil theft and pipeline vandalism, what does that mean for the economy? Well,
extremely good question. I of course, what we don't have is the full breakdown of the spending per ministry. So we can't say agriculture, for example, is getting, I mean, it could be that agriculture is getting a higher allocation, and for example, let's say judiciary, not just or let's say transport might be getting lower. We haven't seen the details, but no, I mean, but I think really the main point is the headline, as you say, the fall off in expenditure. But I think there are 2 points to make. One is what really counts is less the total of expenditure than the efficiency of expenditure. And the record on capital spending hasn't been brilliant, let's say. We all know about the catalogue of unfinished projects. And the other point to bear in mind is where this expenditure figure, as we said, the 4.5 trillion, whatever, for 2014, and actually it could turn out that that's quite close to where we get for the actual figure for the current year, right? So it could turn out that the 4.99 trillion in this year's budget could actually be lower, and lower because the revenues are lower, forcing a trimming of expenditure.